Today, we are going to be talking about the Vermont Flexible Capital Fund, and wait a couple of minutes for folks to join the group here, and we'll kick things off. It's a beautiful sunny day in Montpelier today, and after a couple of days of rain, much needed rain. So, well, we'll get started. My name is Michael Thompson. I'm the partner and senior wealth advisor here at Copperleaf Financial, based in Vermont. And we do these monthly town halls. This month, my guest is Janice St from the Vermont's Flexible Capital Fund, and I'm so excited to have Janice on. It's been a long time that I've wanted to get Janice on so we could talk about the Flexible Capital Fund and all the great work that they do. So I'm very excited about that. A couple of housekeeping pieces to note. We record these sessions and we will post it on our website, the Copperleaf Financial website, in about a week. So sometime next week, the recording will be up. We do encourage questions. So those of you that are on, if you have questions, please enter them in the chat or in the Q&A down below, and we'll pick those up as we go. And we're going to go for about an hour today. So that's a little bit of housekeeping. Janice St is the president of the Flexible Capital Fund, an impact-focused CDFI fund that provides flexible capital to businesses in Vermont's food system, forestry, clean technology businesses. We're going to talk today a little bit about the history of the Flexible Capital Fund, how it operates, how it actually provides capital to growing Vermont companies and others, and how investors can participate in that. Where does the funding come from for the Flexible Capital Fund? Janice has been with the Flexible Capital Fund from the beginning, and she's going to tell us a little bit about the history today. And I also note that Janice is the co-founder of the Stowe Energy and Climate Action Network, and is a former International Ski Federation World Cup freestyle skiing judge, which I think is really cool. I didn't know that about you. That's super cool. Well, Janice, welcome. Thanks for joining us today.
Great. Thanks so much for having me today, Michael. I appreciate it.
You're welcome. So let's start at the beginning. Tell us first maybe tell us about your background. And how did you get into this? What kind of brought you to the Flexible Capital Fund? And then I'm really curious. I think people want to know about the origins of the Flexible Capital Fund. But what's your background?
So pretty logical, I would say, making my way to the Flexible Capital Fund. I started out in the ski industry. This is a joke, actually. Started out in the ski industry, working for a ski company, and then moved from there into banking. So I worked for People's United Bank, which is now M&T Bank, for about 9 years. And that was really the foundation of my understanding of financial management and financial lending. But then moved to Vermont when my kids were young. I grew up actually in Killington, so I was hankering to get back from Connecticut to Vermont with my family. Worked for a small early stage company doing e-commerce fulfillment and senior management. Then moved from there to the Department of Economic Development at the state, doing work with technology businesses, then into higher education, from there at UVM, working with their Vermont Business Center, and then to the Vermont Sustainable Jobs Fund, which is really where the origin of the Flexible Capital Fund happened. So even though that it might seem, it really is illogical for how I got to where I am today. Each step along the way gave me an understanding of the entrepreneurial ecosystem and financial investment structures, and what the real needs were for these companies that are trying to grow and stay in a rural place like Vermont. So that's kind of my background. So I'm a recovering ex-banker, and the origins of the Flexible Capital Fund. Well, we actually, when I joined this nonprofit organization called the Vermont Sustainable Jobs Fund, which provides market development work and programming related to our food systems, forest products, and clean energy market sectors in the state. And you may be aware of the Farm to Plate Initiative, yes, which is the state's 10-year strategic plan in farm and food. So they are an organization that has helped lead that process over the last close to 12, 13 years now. When I joined back in 2008, 2009, I don't know if folks have that memory of what happened in 2009 when the market crashed.
Kind of big stuff happened.
Big stuff. So it was a really a challenging time for the companies in the sectors that this nonprofit worked in forest and food and energy. And I came along with my background in banking and lending, and there was an interest in the organization to live up to its name, the Vermont Sustainable Jobs Fund. So they had been launched out of the legislature in 1995, said, meant to be a fund and do market development work, but never were capitalized to be a fund. So we did we really did our homework and understanding, well, what's the market need? If we were to get into the lending or investing business, what is this? What is the market need? Because you always want to start with that. And what we found at that time, given the situation with the markets, it was that credit was drying up for these businesses in our working lands, our natural resource sectors, and that we really at the time, didn't have a very vibrant angel investor, venture capital network. We had one venture fund. And so we felt like, okay, there's got to be a need for risk capital for companies that are growing in these sectors that can't, where they can't get debt because they don't have collateral or an operating history, and they can't get equity because they're not going to be high enough growth, high enough margins, or, go beyond the region with their markets. So we said, okay, there's a need. Next step is, what does this look like? What is the need? Well, most companies, small businesses, growing businesses in rural New England, Vermont included, probably aren't ever really going to be a great fit for equity investment, where they take on equity, meaning that you have an investor who purchases ownership in the company. They have to grow sufficiently to have a better value of the company so that they can sell, so that the investor can get 3 to 5 times their money back. That's the scenario. Most Vermont companies aren't going to be in that category. And don't get me wrong, equity and venture is a very much needed type of capital for those companies that are high growth, high margin, but that's not the majority of companies. So we discovered an investment structure called revenue-based financing that was being done by another impact investment community development financial institution, a CDFI in New Hampshire. It was part of the Vested for Growth program of the New Hampshire Community Loan Fund. So we did our homework and we said, you know what, this could work in Vermont. Let's do this. Let's spin off a new for-profit entity, raise a small amount of capital from mission-aligned accredited investors, and let's do this because we know there's a market need. These are companies that are very important to Vermont from an economic development perspective, from a cultural perspective. This is the heart of who we are. We need to help them grow. So that's what we did.
So that's such a fascinating story. And I think it in a lot of ways, it's so uniquely Vermont because, we're not California where, we think typically there's, high-tech companies that are raising millions and millions of dollars for these fast-growing ventures. And yet we're an environment that's so supportive, and we've managed to create such a supportive environment for small businesses, for entrepreneurs to really get started and build a kind of diverse group of all kinds of companies in all sectors, but primarily focused on these areas that you guys talked about and you guys focus on. I think it's fascinating that, typically an entrepreneur is going to go to the bank or go to other sources to borrow money to get started, or go to friends and family or other investors for investment capital, which means giving away a certain amount of the business and taking on additional risk and having to, if you're really going to get, venture capital, then, it's a kind of a whole different story in terms of who you're taking on as a partner and what the expectations of the investors are. And so you guys kind of found a way to kind of come in the middle. I think that's fascinating. So you talked about this revenue-based financing. That's that sounds great, but I don't really know what that means. So how does
Yeah.
that work?
Yeah, so well, that's the kind of response I got early on when we decided to launch this fund, like deer in the headlights from the bankers. Revenue, what? And from the entrepreneurs, what? How much does it cost? So I'll give you a really good example. Essentially, instead of getting repaid a set principal and interest payment on a monthly basis, like you would with a bank or a community loan fund, or selling a piece of your company, an ownership position in your company, where you then have to sell the company to get a return back to your investors. Revenue-based financing is a loan, so it is considered debt. So Michael, I'm going to lend you $100,000. I'm going to keep the math simple, and you need to pay me back $200,000 in 7 years. And your company right now is generating $1 million in revenue. So you're going to pay us when this is all part of the conversation where we talk about what the cash flow needs of the business are and how they can, how much of a revenue share payment they can support. You're going to pay us 1% of monthly gross revenues until you get to 200,000, the multiple on our money. And when you're done, when you've paid us that amount, you're done. The loan is retired, and you move on. And hopefully that money has allowed you to grow. So it's permanent working capital to hire people, to support sales and marketing, to, really things that you can't collateralize. People walk out the door. A bank wants, collateral. They want equipment. They want a personal guarantee. We don't need a personal guarantee. We don't need necessarily collateral, which is why our money is higher risk, because we don't have those things that a bank would want. Banks basically asking for, they want the cash flow, they want the collateral, they want a personal guarantee secured by a second mortgage on your home and your firstborn child, right? So these are, we don't need it. We like to have it, but we don't need it. And so we can function more like equity from a risk perspective. So that's where essentially we have a set multiple. Once you've paid us off, you're done and you can move on. And sometimes that means we've bridged you to an equity round where the value of our company is worth more because you've grown. Or now you can go to the bank because you have an operating history and you have collateral. So it's a good instrument that's a little bit higher cost than a bank loan and lower cost than equity, which is really going to angel investment, look at 3 to 5 times your money on exit.
And fascinating. And you guys have done fabulous work with lots of companies, local companies that are doing amazing things. I think I want to talk about that in a bit and tell us some stories about some of these businesses and maybe some examples of some of the companies that you've invested in. But I'm wondering, is there a typical stage at which you guys are getting involved in the company, and do you find that you're partnering with other sources of capital at the same time typically, or are you coming in at a stage where you're really the sole source of capital to kind of help at that stage of the business, or what's that look like?
So it depends. So I'm just going to be honest. It depends. One thing I can say is we're not startup capital. It's called revenue-based financing or royalty financing for a reason. You have to have revenue.
Got to have some revenue.
If you don't have revenue, we don't feel it's a good structure, right? So for startup capital, not there. But for a lot of companies who are growing and getting up to that $500,000, $600,000 annual revenue mark, up to $1 million, you're starting to really scale the business and need more than just maybe yourself and 1 or 2 people. Like you need to build the team, you need to actually invest in sales and marketing. And that's really hard capital to get right at that $1 million mark. If you're at 5 million, different story, startup capital. So that sweet spot of annual revenue between 500,000 and 600,000 up to $1 million is really where we've come in and been able to have impact. We certainly have invested in companies that are in the $3 to $4 million range that have been challenged with getting equity and want to get there, but need to build the valuation of the company so we can come in and support them, help them grow, get back to profitability. So not startup capital, probably growth stage companies who have decent margins. So, we're taking gross revenue percentage off the top. So if your margins are 7, 8, 9, 10% gross profit margins, we're not a good fit because you can't really afford to have that percentage come off the top. Right.
Right.
So not, so we really, in the food system space, for example, we're really a good fit for distribution companies, for food manufacturers, probably not farm and production.
Not
Does
enough
that make
margin.
sense? Right.
Yeah.
And you need to be growing, again, not the growth rates that a venture or angel investor is going to be looking for at 40, 50, 60%, 20%, right? But, so you need to have some growth trajectory to pay us back.
Yeah, that makes sense. I'm curious about, I know you guys have been involved with a lot of companies, meaning the impact that you have, that the Flexible Capital Fund has had, I think has been tremendous in terms of how you've provided funding for some meaningful companies that have really gone on to continue to have an impact in the state in terms of certainly employment and continued growth in our economy and things like that. So I want to hear some of those stories. Are there any in particular that you'd like to share? Any stories that you're particularly proud of without giving away any secrets? But I know you have a lot of press releases and a lot of good stories out there.
Yeah, I mean, a couple of companies, I would say in most of the sectors that we're in, I would start with a company, Encore Renewable Energy, which is a B corporation. We funded them. Our first note with them, our revenue-based financing note with them, was in 2016, when they were probably 5 or 6 employees, and mostly white men. And so as they grew, they needed a second revenue-based financing note, and we were able to do that with them and brought in other investors, because our limit typically will do between $100,000 and $400,000 in any one investment. And once we get past that, we have to bring on other participants to support the if somebody's looking for $1 million, we can help facilitate that, but we can't do it all. So we always, in case like Encore, we brought in like-minded, mission-aligned, values-based investors from one of the investors from the New Hampshire Community Loan Fund. So we brought outside money to help support a Vermont company grow, which I think was spoke a lot to the partnership that we have with other like-minded CDFIs, like community development financial institutions in New Hampshire and Maine. We've brought that kind of capital into Vermont to support Vermont companies. But they grew when they paid us off last year in the second note. They are now close to 30 employees, 50% or more of which are diverse team members, including women, people of color, non-binary. So really important diversity mix that has helped them grow to be a better, more profitable company. So that's a real success story for us. They were able to take on a large financing recently. And so it's gratifying to know that they've been able to grow and do it in a way that's thoughtful and meaningful to the Vermont economy and to their employee base. So that's one example. That's
a great story.
Excuse me.
I saw in the news recently that a local company just received, I think, $750 million from was it from the federal government to continue to expand their business, Core Solutions, and I think they're one of your in companies you invest in, are they not?
Yes, they are. And again, that was another example of a company I think we invested in them in 2017 or 18. At the time, they were known as Northern Reliability, which we're doing storage solutions for renewable energy projects and other types of remote locations. And we came in when they had just taken on a new CEO. They had a number of equity investors, but because of challenges that they had growing their revenue, they didn't want to do another equity round until their valuation of the company was improved. So revenue-based financing as an instrument was a really good solution for them because they weren't locked into a fixed principal and interest payment, but it was working capital to help them grow. And they recently, in the last year and a half, were sold or merged with Core Power, which is their parent company out west, excuse me, and changed their name to Core Solutions. And so they still remain in Waterbury, and they've since paid off our revenue-based financing note. And Core Power just announced that $750 million, or no, it was more than that. Was it in the billions? It was
I don't know.
Large dollar amount
Yeah.
loan from the Department of Energy to build a domestically based manufacturing facility for battery storage for renewable energy, which is a real win for the U.S. and for renewable energy and moving us forward in terms of our need to get off of fossil fuels and promote make a difference in climate change. So that's again another success story that we're really proud of.
That's big impact. I mean, you folks must. How do you think about your impact? And do you have, as part of your mission, do you have goals in terms of impact and how you measure your impact? How do you think about that?
Yeah. So, I mean, broadly speaking, our mission is to invest in companies that are building healthy food systems that all Vermonters, all New Englanders can access. So equitable, affordable, healthy food locally, and that are also working on climate change solutions. So mitigating climate change, getting off of fossil fuels. These are our most pressing issues that we have, not, all over the world, really. These are big, big issues, and we're trying to make a difference in Vermont, in the region, with this capital. And these are the entrepreneurs that are doing it. So that's our broader mission, is to mitigate climate change and build healthy food systems and preserve our working lands. So we do an annual survey with all of our portfolio companies and put out an impact report for our investors. That when we first raised capital, we had 38 investors raising close to $4 million to support the fund. And so we want to help them understand, the real impact of their capital and what it's doing day to day in the communities that they live, and how those companies are feeding their families and, getting us off of fossil fuels. So we do the impact report. We talk about quality jobs that are created and retained. We talk about reduction in carbon emissions. We talk about living wages that are paid and impact of the local dollars being cycled through the communities, in the communities that these companies are located. So we do measure that on an annual basis. And there's a lot of anecdotal stories as well as to the good that these companies are doing.
I'm sure it's really good, and I think certainly something to be proud of, and that in Vermont we should be proud of the work that you guys are doing, and that you're there as part of the amazing and unique infrastructure that we have here in Vermont to support small business owners and entrepreneurs making a difference. I'll remind people that we, if you have questions, enter them in the Q&A. We do have a question now. Someone asked, could you repeat, please, your ideal range of money that you usually lend without other partners getting involved? And I think, did you mention 100 to 400,000, Janice?
Yes, that's correct. And I will say, you'd asked the question earlier, who do we collaborate with? We traditionally don't like to go into a deal by ourselves. So typically there's either an existing mission aligned lender or investor already invested in the company, or, we'll look at, for example, partners like the New Hampshire Community Loan Fund or Fair Food Fund, which is another impact fund that's based in New England, doing work in food, just in the food system side of the space. So, we'll try and say, okay, we'll bring this amount to the table if you get another investor, so that the benefit of that for the company is now they've got two investors who are aligned with helping them grow, that have two sets of pockets are deeper than one, right? So if they need additional capital, which honestly, every company says, oh, well, once we get here, we don't need any more capital. That's never the case. Let's just be honest. You're always going to need more capital. So you want to have investors that can come back to the table and support you. So that's why we want to do this in alignment with our valued partners like the Vermont Community Loan Fund in New Hampshire and Coastal Enterprises, other CDFIs that are committed to the rural low-income communities that they serve.
Yep. And from my experience of being on the board of the Vermont Community Loan Fund, I know that we almost never go into a deal without other partners like the Flexible Capital Fund. I think that just is a great model and it seems to work well for everybody. Let's talk a little bit, Janice, about where your capital comes from. I mean, obviously, some of it comes from sort of internally generated as the revenue based funding kind of circulates back to you guys. You've got more money to be able to reinvest back out into the community, out into other businesses, but you must have to raise capital periodically. And I think from time to time you go through other rounds of raising capital. You talked about 38 investors initially. I'm not going to ask you specifically who those investors are, but what types of investors are they? Are you getting your investment dollars from foundations or from other nonprofits, or is it coming from individuals or institutions? Where's your capital coming from, and how does that work?
So all of the above. So when we did our initial raise to launch the fund in 2011, 2012, as I mentioned, we have 38 investors, primarily from New England, but also from around the country, who are interested in our work and the unique nature of the structure that we had in terms of revenue-based financing as an alternative to equity, a non-extractive alternative to equity. So, these are socially responsible, mission-aligned investors that are high net worth individuals. We had a few nonprofits. We've got some philanthropic organizations as well that have supported our work throughout the years. And then in 2014, we decided to become certified as what's called a community development financial institution. So there are, probably 5 or 6 CDFIs in Vermont and then throughout New England, and many others that are doing both business lending, housing work, affordable daycare work, et cetera. And to get certified as a CDFI means you have to commit to addressing low-income communities in your market area, and our market area is Vermont. And so we became certified, and so we have had access to additional capital through the CDFI fund, which is part of the U.S. Treasury. So you have to apply for it, and it's a rigorous process. And so we've had 3 awards from the CDFI fund over the last 11 years that have supported us and provided us even more ability to bring this higher risk capital to Vermont. And now we just did our first 2 investments outside of Vermont in Maine. And so those 2 sources have been very much aligned with our mission in trying to get this money out to support communities and to support companies that are doing this bigger systems change of climate change solutions and food systems work. And so, as we continue to see, there's still a huge need for this alternative investment structure. And especially, throughout New England, we're the only CDFI proactively using this structure on a regular basis in New England right now. And so we are looking, we are expanding our geographic reach and, looking to raise capital to support that. So
I know many of our clients are very interested and committed to not only sustainability, but supporting local businesses as much as they can. And the opportunities for local investors to have a genuine local impact is pretty limited. So I would think there would be, a ready market for capital for interested investors wanting to participate and wanting to invest in your fund. How would investors find out about that opportunity? How would investors connect with you if that was something? And I know you're not soliciting, and we can't actively solicit. You can't actively solicit here, so we're not doing that. But as a point of curiosity, if a Vermont high net worth individual had an interest in investing in Vermont, how would they get in touch with you and find out more about that?
Yeah, I mean, I'm happy at the end I'll put in the chat box my contact information. That's the best way to learn about our work. Our website is, also a wealth of information about how revenue-based financing works, about who our portfolio companies are, why this kind of capital is so important to these pressing issues that we're facing right now, and how we do our work. One thing I didn't mention was, in addition to the capital that we do offer connections to business coaching, technical assistance. We have some grant dollars to support our companies if they needed a particular consultant to help them with whatever issue that they're going through. We do a monthly portfolio call, building a community of practice among our entrepreneurs to really ensure that they know that they're not in this alone, because our biggest mantra is we don't invest in companies, we invest in people. Because it's the people, it's the entrepreneurs that are doing the work of creating the jobs, of doing this climate change solutions work, not us. We're just a tool of capital and hopefully support and coaching to help them be successful. So, so our website talks about that as well. And again, happy to have a follow-up conversation with folks who just want to learn more about what we're doing and where we're headed, because I think it's exciting. When you think about these issues around climate change and food systems, it's regional, right? We have the Northern Forest. The Northern Forest is regional. So how do we support our natural resources and keep our working lands in play regionally? Because we're all in this together. Honestly, we're all connected.
Well, and in my experience, our clients are very interested in being involved and supporting, speaking with their dollars to support local businesses and having an impact locally. So I would think there would be a sort of a ready source of capital and investors wanting to participate. Remind people that if you have questions, enter them in the Q&A. We have another question. John asks, what recourse does the fund have if company revenue is not sufficient for the borrower to be able to pay back the loan in the planned timeframe? I had a similar question, which really had to do with your due diligence process. You're taking on a fair amount of risk. You're entering these companies at a pretty risky phase, and as you said, you're investing in people. In addition to the question, maybe answer the question, but then what's your due diligence process look like? How do you do the best you can to make sure that you're making a good investment?
Yep. So a couple of things on that first question related to what recourse do we have. We've had a couple of notes, revenue-based financing notes now that have gotten to maturity and not been paid off. So when that maturity date happens, it gives us the ability to sit at the table with the entrepreneur and have a conversation and say, okay, look, you didn't meet expectations on what your projections were for your revenues. What's the plan? Let's talk about what your plan is going forward, and how are you, what kind of cash flow will you be able to support shared revenue payment going forward, or do we need to restructure the note to a straight principal and interest note to get us paid where we're at? So even at maturity, that's the conversation that we have. If they haven't paid us off, we have yet to call the note and say, here's the lump sum you owe us, because that's not what we're about. We want to keep those doors open. But we do negotiate either an extension of the maturity date or accelerated schedule of revenue share payments or restructure. So, and for the most part, in those situations, we've been able to extend the maturity date and then get paid in full the amount that we were looking for. And it just took them longer. And I think that's over 10, 11 years, we've learned that these companies that are really making systems change, they're not going to 5 years is not enough time for them to do this work.
Yeah, it's a
7, 8,
it's a blink of an
9,
eye.
10 years.
Yeah.
It's a blink of an eye. And so in a venture model that's, a 10-year fund with a 5-year investment period and needs to get paid out in five years, that doesn't work for the majority of companies trying to make systems change. So that's where we are patient risk capital. So we do, when we can, we will take a second, or a third lien on business assets. So we do have that as backup for payment. We will take a personal guarantee if it makes sense. Sometimes the entrepreneur doesn't have the assets, so it doesn't make sense to put that added stress on them. I've become more and more aware that a personal guarantee, it's a nice thing to have, to say you have, but it doesn't really, we're not going to take somebody's home from them. We're not going to call our guarantee.
Yeah.
So yes, it is riskier, which is why this is not, 5% money. It's not 6% money. It's not, and it's not based on an interest rate. It's based on an internal rate of return, the time value of money, how long it takes you to pay us 1.6 to 2.2 times our money back, which is again, less costly than an angel investor or venture fund. So hopefully that answers that question. And when it comes to due diligence, so it is due diligence. It's not underwriting. So I came from the banking world where you underwrote, you do underwriting for a note, it's collateral, it's cash flow, it's loan to value, none of that. So due diligence is about understanding the team and their competencies, understanding the market and making sure they understand their market and that they have a vision of where they want to go, understanding the projections and that whether the assumptions are valid. And then, making sure that the entrepreneur is coachable, because the other thing I've learned in 11 years, don't lend to jerks.
Yeah.
Right. You don't.
Got to be good partners, right?
Got to be good partners. What we are partners, not just lenders and investors. We're partners. So due diligence is not a short process. We typically can be anywhere from 6 to 8 to 12 weeks, depending on how much information we get, how often back and forth, always going to see, visit the company, get to know their team, get to know them personally, because we build a relationship. It is all about relationships.
And, that makes me think also about your investors too. You must have to set an expectation with your investors in terms of time frame. I'm certain that as you have to be patient and are patient with the companies that you invest in, you must have to ask the same thing of your investors. What's the typical time frame that you talk about with your investors? Again, we're not soliciting, but in the broadest sense possible, when you talk to investors, what do you say in terms of time frame?
Yeah, so this current fund is a great example where we're at. We originally set this up as a 10-year fund with 2 extra years. And because of the structure, because it's revenue-based financing, it's self-liquidating. So when on a monthly basis, we get repaid just like a loan fund would.
Oh, yeah.
So we have cash coming in. We can choose to reinvest that cash in new businesses. Or if for example, we've had some exits that have been they've grown so fast and they take on that next round of capital that just wants us off the balance sheet, we've gotten paid back and that gets distributed out to our investors. So starting in year 4, we had an exit with our very first company, Vermont Smoke and Cure. You may remember that company. And we made our first distribution back to our investors. And ever since then, we've been able to distribute capital back to our investors on an annual basis. So that by the time this fund is done, they'll be close to 100% getting their investment capital back. So that's the intent as we move forward, is because revenue-based financing, the money coming in to us is coming in not just based on when that company sells, but every single month. We have the ability to reinvest and or distribute out as we have the cash flow to our investors.
Can you talk about on your website, you talk about Fund 2.0. Can you talk about kind of where you are in terms of raising additional capital or new investment money? Is that something you can talk about at all now?
I think because of, I have to, again, we can't solicit. So
Right.
certainly if people want to learn more individually about what we're doing, I'm happy to have that conversation. I will say we're excited because we've done our first 2 investments in Maine that have been really in complement to our existing portfolio. So, we're at the point now where we really want to be able to look at companies that are supporting this work broadly in the region, that have diverse teams. And I think that's the other thing as we move forward, what we've learned, and we knew this all along, we're a women led and managed fund. And we are really, really using as part of our screening process, this idea that you need, if you aren't already a diverse led entrepreneurial entity, we want to see you move in that direction, because diversity of gender, diversity of ethnicity and race, they all add positive perspective and different perspective to a business. And the data shows that diverse led companies and women led companies are more profitable than all male led companies. So, diversity, equity, and inclusion, we have in all of our revenue-based financing notes a diversity, equity, and inclusion rider, where if the company isn't already have one in place, they need to have a policy, and they also need to be working towards diversifying their management team, their governance team, their advisory board, their vendor base, et cetera.
Are there other examples that you can share of other companies that that you've invested in, and sort of success stories? I think about I don't know, Grow Compost, but they're one that comes to mind. I don't know if that's a story
that's a great story of a combination of when they were Grow Compost is a composting company, and they also morphed their business model to also do food scraps hauling back in the day when I think it was Act 148 related to recycling and waste reduction, a bill that passed in the legislature, was signed into law that requires not, initially it was just institutions, and now everyone is required to keep food scraps out of our landfill. For obvious reasons, for carbon emissions, for better soil, et cetera. So when that act came along and they were already composting, they recognized that here's an opportunity to do food scraps hauling from schools and places like the Alchemist Brewery, where they were taking the spent beer, byproduct, and bringing that to digesters and feeding it to animals, and ensuring that wasn't going in the landfill to create, carbon emissions. So they had a hard time trying to get debt or equity. And so they were a business coaching client of the Vermont Sustainable Jobs Fund. So that was a great referral. And we were able to provide them with a royalty note or royalty-based note that helped them grow, helped them with hiring more people, helping them expand their routes, their food scraps hauling routes. And ultimately, in the end, they grew that business to the point where they could then sell the company and move on to do their next adventure. So that was a success. And the company they sold to kept all of their employee base, gave them raises, all of these things that it's difficult for a small business when they're growing, because they're trying to just keep the cash, put it back into the business and grow. Right.
Great story. I love that one. And another one that I wonder if you can talk about a little bit is Global Village Foods. Is that another one of the companies that you've invested in? And
that's one of our more recent investments. Great couple, Mill and Damaris Hall, who are doing making African cuisine. Primarily, they started out doing it for food service, so colleges and universities. They do some small independent retail and are moving into retail as well. And a great story of them needing capital to grow, and again challenged because they were early stage and couldn't support a traditional term note structure for the working capital, the people, the sales and marketing component that they needed to grow. They already had a note with the Vermont Community Loan Fund, so really good partner for us. And, I prefer to work with a CDFI than a bank because we've had challenges there, but banks are necessary as well and an important part of the capital continuum. But we knew we had a good partner with VCLF, and we brought in the Fair Food Fund, which does work in the food system space, to participate in our note, our royalty note. And we're able to support them not just with capital to help them grow, but also with business coaching support, initially through Fair Food Fund, to work with. They started working with a contract CFO to support them in their financial acumen. And then we brought in the Vermont Sustainable Jobs Fund's business coaching program to support them in the strategic planning component of what they're doing. So again, a great opportunity. And, to boot, in this case, it was a couple of color who are also committed to sourcing local. So they recently got a grant from the Kendall Foundation to support finding and sourcing local produce for their stews and their samosas and all of the really amazing food that they make.
That's a great story. I love that. Let's talk about the future a little bit and kind of what's next for flexible capital. And for a number of years I was on the board of the Intervale Center, and the Intervale Center was kind of known globally as a source of innovation, and had people come from all over the world to visit the Intervale Center and learn about some of the programs that the Intervale was doing. I wonder, it strikes me that the revenue-based financing that flexible capital is doing is so innovative and may not be known widely. Are you getting interest from other folks or other entities that are coming to you to learn about the work of flexible capital and learning about revenue-based funding and what's the future? What do you see as the future for revenue-based funding? Is it a model that's here to stay,
absolutely. I think so. So, in the last 10 years, since 2010, 11, when we started and I got the deer in the headlights, now fast forward a decade, and people actually, most folks, primarily more on the investment side than the lending side, understand or know or have heard of revenue-based financing. So it's become more of a household name in the investment community. And so I just joined a revenue-based financing peer group that's comprised of a group of national, CDFIs from all over the country to build a community of practice around this type of investment, and to help the CDFI world better understand how it could be a viable investment structure as an alternative to equity, as a non-extractive alternative to equity investment. So, I think you're seeing some of these peer groups pop up. There's a revenue-based financing network that's national now, and there's periodically webinars and newsletter goes out. So it's becoming more better understood. I think there's still a ways to go. It's not, with the norm in conversation like preferred equity for an angel investor or a term loan for, the banking community, but it's getting there. It's better. And it really is, as I mentioned before, we need all of that capital because companies are different. They have, they need different kinds of capital at the different stages of growth that they're at, depending on what market they're selling into, depending on what the entrepreneur's goals are. Do they want this to be a lifestyle business, or do they want to grow big, grow fast? Those are two different types of capital.
Very different, yeah.
Yep.
Interesting. So I'm hoping that you're getting recognized and that people are paying attention to what you're doing, and you guys are helping to lead the way. It sounds like that's a really good thing. what's the future look like for the Flexible Capital Fund? Are you experiencing as much growth as you want? Do you see the fund continuing to grow at an aggressive pace, or kind of what do you see as what's the future look like for the fund?
Well, I mean, again, I can't go into details, but we are in the process of raising that next round to keep going, because I think there's still a lot of work to be done. And we are expanding our geographic reach to all of New England with trusted partners. So we'll always be Vermont focused, but we will definitely do investments in New Hampshire, Maine, and Massachusetts with trusted mission aligned values partners. So, that to me is the most exciting part, because we can really help these innovative companies who might not have an alternative to equity or an alternative to debt grow in the way that they need to grow. And then to link them into a regional network, to me, means that we can hopefully go further faster in this work around climate change and food systems solutions. So, that's really what we're looking to do. We're hoping to get this second round done by end of year if possible, and keep going, because again, it's an important work that we're doing, and we want to do it in partnership, and where we can add value in terms of our knowledge. I mean, we've been doing this for 11 years. We've learned a lot of things and done a lot of things right. And we've done a lot of things wrong, and we've learned those lessons. And, I guess that's the one thing I would say is we're really good at talking about success in Vermont and how we're helping entrepreneurs grow their businesses, but we don't talk about failure enough and how those lessons learned from failure. We've had 4 of the 23 businesses that we've invested in have closed their doors.
Wow.
And that's 4 more than, anybody would want, right?
Yeah.
And those companies are no longer in business. Those people no longer have their jobs. That community is no longer, supported by that business. And that's devastating. And so how do we help take those lessons learned and move them on to do a better job at supporting these entrepreneurs and helping them grow and be successful?
And are there any lessons off the top of your head from those failures or other failures that you've seen that you can share, or that you have kind of brought back into how you, maybe your due diligence process, or how you educate current companies, or kind of how do you think about that? What are the lessons?
Yeah, I mean, the biggest one is it takes longer than you think for a company to get off the runway. And if all of the parties involved in a particular financing for a business were a little more patient, things might not have come out the way they came out. And I think, when you, I guess the other piece is small is the new big. Sorry. I did not expect that to happen. Small is the new big, that, really we're a small player when you look at some of these regional banks that are involved in the deal.
Sure.
But collectively, with a couple of small players that support a company, you can make a difference even against the bigger players. And so, those are the 2 big ones. And then I think that one of the biggest things, and especially this was because of COVID, entrepreneurs are people too. Like they don't stop their personal life and challenges at the door when they walk into their business.
Right.
And it's really, we really have to remember that the statistics show that the rate of depression and suicide among entrepreneurs is higher than the general population.
Yeah.
And so when we invest in an entrepreneur, we're investing not just in the business, but them as people. And so bringing compassion and empathy to the work, even when things aren't going well, it's even more important to bring that compassion and empathy to support them, because it's mental health and entrepreneurship go hand in hand because of the pressure, because of the challenges. And COVID really exacerbated that, when some of those businesses in our portfolio, one day they were doing well, the next day everything shut down and no revenue. And so how do you support entrepreneurs. So it's not just writing the check when you invest, it's then supporting them through some really challenging times.
I'm really glad to hear you say that and talk about that. And that certainly, I imagine, is something that the business owner is not typically getting from the bank. You know, I'm not going to be looking to my bank for empathy or for support when things aren't going well, and I'm kind of teetering on the pit of doom mentally.
Right.
But if I've got a partner, if I've got a friend that can support me and help me kind of see my way through it in the flexible capital fund, that can, I would imagine, make all the difference sometimes. So
We like to hope so.
yeah, that's a really good thing. What are the biggest challenges for you for the flexible capital fund, Janice, as you think out to the next few years? What are the biggest challenges that you see?
I think it's really understanding that there's this feeling sometimes that I get in other places that they're from away, so we, let's not work with them because they're from away. But the
Right.
idea is I want to change they're from away to we're all connected, like understanding that where you put your money has an impact. And so, there is this, it's been interesting to try and raise capital in this economic environment, given what's happened with the markets, et cetera. But there's a lot of money sitting out there.
Yes.
Doing nothing or doing not good. And so how do we, whether it's us or any individual who wants to put their money in alignment with their values, how do we take a little bit of that money and move it towards doing good? Because there's so much there that it's just a shame to be sitting there and not doing something to help these companies make real change. Because if we don't, we see the writing on the walls with climate change and what's happening with weather patterns, what's happening with the wealth, gap between the highest and the lowest, folks out there. And it's, we need to all be part of the solution here. So
it's really true. I'm glad to hear you talk about that. We talk about that with our clients too, really aligning money with values and investment with values is an important part of what we do. And well over 70% of our clients are investing in a sustainable portfolio focused on climate change and social change and things like that too. So that's important. I think I'm glad to hear you talk about that. So Janice, you guys are doing good work. You have a long track record. I imagine you've got another, hopefully a few decades ahead for the Flexible Capital Fund. Who's out there supporting you? Is it just you in the office? Do you have a whole crew of support staff and other people that are managing the fund and all that, or who actually is staffing the organization now besides you, or are you doing it on your own?
No, this is not work I could ever do on my own.
I wouldn't think so. Yeah,
not at all. So I am so fortunate to have a fund manager in the Vermont Sustainable Jobs Fund whose staff, I have finance director Anthony Monona, executive director Ellen Kaler, who's my biggest champion, and Kelly Notterman, who is our marketing person. So we contract with them, the fund company with the Sustainable Jobs Fund to do that support work. So it's so critical. And then I have an amazing board of managers who are there to support us all the way and really do the hard work of making the decisions along with our investment committee. So, and they're all listed on our website. I don't want to, take the time to go through them, but just an amazing board with expertise in investing, in sector expertise, in understanding what the really the challenges that we're facing and how we can do this work and taking risk where others aren't willing to do so. So I would say it takes a village to run a fund, so to speak.
Yes. Yeah.
And
Yeah.
I do have that. And then as we move forward, as we grow the fund, we'll bring on another fund manager, which I'm really excited to have another colleague help me do this work.
Great. Well, thank you, Janice. I can't believe an hour is passed. It's been great getting to know you and getting to know the Flexible Capital Fund a little bit more. I know that that the folks that joined us today got a lot out of it. I noticed that you put your contact information in the chat, Janice at flexiblecapitalfund.com. Thank you so much for joining us. Next month in July, my guest for the Copperleaf Town Hall will be Joel Solomon. We're happy to have Joel back to talk about his book and talk about his approach to investing too. So thank you, everyone. Look for the recording up next week, and have a fabulous rest of your week. And thanks again for joining us today. Thank you,
Yeah,
Janice.
thanks so much for the opportunity, Michael. I appreciate it. And don't miss Joel. He's awesome.